Most traders mark support and resistance levels, but few actually use them the right way. If you've ever placed a trade at a support level, only to watch price break right through it, or entered at resistance expecting a reversal, only to see price explode higher, you're not alone. That's because trading support and resistance isn't just about drawing lines on a chart, it's about knowing which levels actually matter and how to trade them with confidence. In this video, I'm going to show you how to correctly identify strong support and resistance levels, how to draw them the right way to avoid confusion, and a simple yet powerful trading strategy that will help you take high probability trades using these key levels. By the end of this video, you'll have a complete understanding of how professional traders use support and resistance, and how you can too. Before we dive in, make sure to smash that like button, subscribe, and hit the notification bell so you never miss future trading content. Alright, let's get started. Support and resistance levels are key areas where price reacts, and knowing how to identify them properly can set you apart as a trader. These are zones where potential trade opportunities arise, so you always want to have them marked in advance as a guide for when price approaches these levels again. Now, how do we identify strong support and resistance levels? Here are the essential criteria we look for. Major swing highs and lows. We start by identifying the extreme turning points in the market, the highest and lowest price levels that have been reached recently. These are key areas where price has reversed in the past and could react again. Multiple price rejections. The more times price has bounced off a level, the stronger it becomes. A level that has been tested multiple times without breaking is a clear sign of strong support or resistance. Clear and obvious levels. If you have to struggle to find a level, it's probably not a strong one. A good support or resistance level should stand out immediately when you look at the chart. Strong price reactions. When price moves aggressively away from a level, it signals that a significant amount of buying or selling pressure came in. The more explosive the reaction, the more important the level is. Role reversal. A strong level should act as both support and resistance at different times. If price breaks through a resistance level and then comes back to test it as support, or vice versa, it confirms the level's importance. Recent respect of the level. The more recent a level has been tested and respected, the more relevant it is. While historical levels matter, the freshest price reactions hold the most weight. The best levels will check off multiple criteria, but you don't need every single one to validate a level. The more of these conditions a level meets, the stronger it is. Now, let's jump into the charts and break each of these down with real examples so you can see exactly how to apply this in your trading. Now, let's go step by step through the key traits that define strong support and resistance levels, starting with the first one. The first thing we look for is the highest and lowest price points that have been reached in recent market movement. Looking at the chart, we can see that price moved up, hit a high point and reversed. This is a swing high, a potential resistance level. On the other hand, price dropped to a low point, bounced back up, and that marks a swing low, a potential support level. But identifying these levels is just the first step. We don't take trades blindly just because price reaches a high or low. We always wait for confirmation from price action before making a move. A single touch doesn't make a level strong. What really matters is how many times price has rejected the same area. Looking at the chart, price has tested this level 3 times, rejecting it on each attempt. This tells us that traders are actively reacting to this level over and over again. The more times a level is tested without breaking, the stronger it becomes. Why is this important? Because a level with multiple rejections proves that buyers or sellers are stepping in at that area repeatedly, increasing the probability of price reacting again in the future. The level should be obvious. A strong support or resistance level should stand out immediately. If you have to look too hard to find it, it's probably not significant enough. Looking at the chart, notice how price has clearly reversed from this area multiple times. It's a well-defined resistance level. Similarly, at the bottom, price has bounced strongly, forming an obvious support level. In contrast, there are smaller, less noticeable levels that may still hold some significance, but they are mostly used for intraday trading. For now, the focus should be on the high-impact zones that the majority of traders are watching. And that's exactly why obvious levels matter. The more visible they are, the more traders will be paying attention to them, increasing the chances of price reacting at these areas again. The move away from the level was strong. Not all support and resistance levels are created equal. A strong level will cause a significant price reaction, not just a minor hesitation. Looking at the chart, we see that each time price touched this level, it moved away aggressively. The bigger the move, the more traders reacted at that level. A strong rejection confirms that buyers or sellers stepped in with force, making it a more reliable zone for future trades. The level acts as both support and resistance. A strong level doesn't just hold once. It flips roles over time, acting as both support and resistance. In the chart, we see that the price has bounced off this resistance twice before, eventually breaking above. Once it did, the same level that once acted as resistance turned into support, rejecting the price from the opposite direction. This role reversal is a powerful confirmation that the level is highly significant and should be on our radar for future trades. The level was recently respected or formed. The final trait of a strong support or resistance level is that it has been respected recently. Looking at the chart, price has rejected this resistance area multiple times in the recent past, showing that traders are still reacting to it. Even though older swing highs and lows can still be relevant, the freshest price reactions hold the most weight. Now that you know exactly what criteria to look for, let's put everything together and start marking the key support and resistance levels directly on the chart. But before we begin, here's a crucial reminder. Not every level needs to meet all the criteria we discussed. However, the more traits a level fulfills, the stronger and more reliable it becomes. With that in mind, let's apply this approach step by step. Take a look at this chart example. Starting from the highest point, we identify a clear resistance level where price reached a peak, reversed sharply, and dropped. So, let's plot that level. Now, what makes this a strong resistance level? Let's break it down. Extreme swing high. This is the highest price point reached in recent time, making it a key resistance level. Clearly visible. This level stands out immediately, and any trader looking at the chart should be able to spot it within seconds. Strong rejection. Price moved away aggressively after touching this area, confirming a strong reaction. Multiple rejections. Looking closely, there are 2 rejections, indicating that price struggled twice to break through. This pattern is often referred to as a double top. Moving down the chart, we find another highly reactive level with 5 clear rejections. Let's draw it in and analyze why it holds significance. Multiple rejections. Price tested this area 5 different times, confirming it as a strong support resistance zone. Role reversal. This level has acted as both support and resistance over time. Initially, price bounced off it as support, but later, once broken, it turned into resistance. Recently respected. Since price has reacted to this level in the current market conditions, it remains relevant for trading decisions. Strong price movements. Every time price touched this level, it moved away drastically, proving its importance. Easily identifiable. A strong level should be obvious at first glance, and this one clearly meets that requirement. Now, moving further down, we spot a key support level where price bounced twice, confirming its strength. Let's mark it and analyze why it matters. Extreme swing low. This is the lowest point price has reached in recent time, making it a significant support level. Multiple rejections. Price tested this level twice, confirming that buyers stepped in each time to push price back up. Strong price reactions. Each time price touched this level, it reversed significantly, showing a clear rejection, clearly visible. Just like before, this level is obvious, meaning traders can identify it quickly without second guessing. Recently respected. Since this level has been tested in recent price action, it is still relevant for current trading decisions. Now, here's something really important to remember. Just because we've drawn these levels doesn't mean we jump into trades right away. That's a common mistake. Instead, once the price reaches these zones, we need to wait for clear price action confirmation before making any moves. This extra step helps us avoid false signals and improves our trade accuracy. Now, let's apply the same process to a different currency pair. Here we have the US dollar, Canadian dollar chart, and we'll go step by step, marking out the key support and resistance levels based on the criteria we've learned. Beginning from the top of the chart, we spot a clear resistance level where the price reached a high, reversed, and dropped significantly. This level meets the following criteria. Extreme swing high. This is the highest point the price has reached recently. Clear price rejection. The price moved away drastically, confirming a significant reaction. Obvious level. This level is clearly visible at first glance, meaning many traders are likely watching it. So, we plot this level on the chart and move on. Moving down, we spot another key level that meets the following criteria. Multiple rejections. The level was tested and rejected multiple times. Support turned resistance. After a breakout, the previous support level became a resistance level. Obvious level. It is easily noticeable on the chart. Strong reaction. Once the price reached this level, it moved away sharply. Further down, we can see another level that meets the following criteria. Obvious level, clearly visible on the chart. Multiple rejections. Price has rejected this level several times. Support turned resistance. The level was initially support, but turned into resistance after a breakout. Finally, moving further down, we identify the lowest level in the market. This level meets the following criteria. Market low, this is the lowest point price has reached. Multiple rejections, the price was rejected twice from this level. Obvious level, easily identifiable at a glance. As you can see, we don't need all the criteria to validate a level. Just 2 or 3 key factors are usually enough. However, as I mentioned earlier, identifying support and resistance levels alone is not enough to place a trade. We still need additional confirmation, such as candlestick pattern signals and other confluence factors, to increase the probability of success. One of the most common questions traders ask is, should I draw my support and resistance as lines or zones? Let's break it down using an example from the British pound, Japanese yen. A single horizontal line works well when all the reversal points align perfectly along that line. As you can see here, by plotting one line, we can identify a clear and obvious resistance level because the reversal points align perfectly. However, in most cases, price doesn't react to a single exact level. It moves within a zone rather than a fixed point. Take a look at this example. As you can see, at this level, price does not react to just one precise price point. Some traders try to connect all candle closes and wicks with separate lines. Let's do that now. As you can see, by attempting to connect every close and wick, you'll end up with too many lines, making the chart cluttered and harder to read. Instead of drawing multiple lines, it's better to mark a zone that covers both the candle closes and the wicks. This approach is much cleaner and provides a more accurate representation of how price actually interacts with these levels. Now that you know how to identify valid support and resistance levels and how to properly draw them, let's take things a step further. I'm about to share with you a simple yet powerful strategy that works across all markets and time frames. It's called the Break and Retest Strategy, and it's one of the most reliable ways to trade using support and resistance. The best part? You're not chasing the market. You're waiting for price to come back to a key level and confirm a trade setup, just like professional traders do. Let's break it down step by step. In an uptrend, price often breaks above a resistance level, but instead of continuing straight up, it pulls back to retest the broken level. This is where we look for a high probability buy trade. Before price breaks higher, we need to identify a valid resistance level using the criteria we covered earlier. Multiple rejections, price bounced from this area several times. Strong price reaction, price moved away aggressively after touching this level. Clearly visible, the level stands out on the chart without needing adjustments. Once price breaks above this level, it signals that buyers are in control, but instead of entering immediately, we wait for a pullback. To increase our chances of success, we look for extra confirmation factors before entering a trade. Fibonacci retracement. The broken resistance aligns with the 50% or 61.8% retracement level, which often acts as a support zone. Candlestick confirmation. A strong, bullish, engulfing candle, pin bar, or rejection wick signals that buyers are stepping in. In this case, we have an inside bar candlestick pattern. Higher time frame alignment. Since this trade is on the 15 minutes chart, we need to check the higher time frame, the 1 hour chart, to confirm that the trend is up, ensuring alignment with our trading time frame. When price pulls back and rejects the old resistance as new support, this is where we enter a buy trade. Once we have all the confirmations, we set up our trade. Entry. After the inside bar formation. Stop loss. A few pips below the support level. Take profit. At the next key resistance zone. By waiting for the right setup, we avoid false breakouts and trade with confidence. Now, let's analyze the opposite setup, where a support level breaks and transforms into resistance. Before price breaks lower, we must first identify a valid support level based on these key criteria. Multiple reactions. Price has bounced off this level several times. Strong price rejection. Each time price touched this level, it triggered an aggressive rally. Clearly defined zone. The level is easy to spot on the chart without frequent adjustments. Eventually, price breaks below this support, signaling a shift in momentum. However, rather than entering a short trade immediately, we wait for a pullback to confirm that the broken support is now acting as resistance. To increase the probability of a successful trade, we look for additional bearish signals that confirm the reversal, candlestick confirmation. A bearish, engulfing, shooting star, or rejection wick indicates that sellers are stepping in. In this example, we have a clear pin bar signaling a potential continuation of the downtrend. Fibonacci retracement. The broken support aligns with the 61.8% retracement level, a key area where price often reverses in a downtrend. Higher time frame alignment. Since this trade is on the hourly chart, we check the daily chart to ensure that the broader market is also trending downward. Once price pulls back and rejects the old support as new resistance, we have a high probability trade setup. To capitalize on this setup, we structure our trade as follows. Entry: after the formation of the pin bar candlestick. Stop loss: placed a few pips above the resistance level. Take profit: set at the next major support zone. Alright traders, now you have a clear understanding of how to identify strong support and resistance levels, how to properly draw them, and even how to use them in high probability trading strategies. But learning is just the first step. The real progress happens when you apply what you've learned. So, go to your chart, start marking those key levels, and practice spotting trade opportunities based on support and resistance. If you found this video valuable, smash that like button and subscribe for more trading insights. New videos drop every week packed with powerful trading lessons. So turn on notifications and stay ahead of the markets. Thank you for watching, and I'll see you in the next video.